In this presentation, we will continue on with part 2 of our example problem related to a not-for-profit hospital. In prior presentations, in part 1, we entered the transactions for a year for a time period. We're now at the end of the time period, and we will be entering the closing entries doing the closing process. We're going to have the information on the right-hand side, which will be the trial balance. This is the trial balance worksheet that we will use to enter the closing entries. We will be journalizing the closing entries on the left side. Our objective will be much the same as a for-profit organization, and that is to take all these dark blue accounts, which would be kind of like the income statement kind of accounts, those timing accounts, those temporary accounts. We want to make all of them zero, closing them out to what would be the equity section in a for-profit organization, typically retained earnings for a corporation, capital account for a partnership or sole proprietorship. Here, closing them to the net assets. However, then we're going to have to deal with the fact that we have different classes of net assets. Net assets with restrictions, net assets without restrictions, two classes of those items with restrictions here. The first entry was going to be our longest entry, in essence, closing everything out, making everything zero. That then, we're just going to go straight through these accounts, do whatever we need to do to make them go to zero. So we've got the patient service revenue. It's a revenue account. It has a credit in it. Therefore, we are going to debit it to make it go down. We then have the other operating revenues. It has a credit in it. Therefore, we're going to do the opposite thing to it, debit it to make it go down. Then we have the investment income without donor restrictions. It has a credit in it. We're going to debit it to make it go down. Then we have the contractual adjustments. These now we're in like the expense type of accounts. Therefore, they have a debit in it, and we need to credit them to make it go down. We have the admin expense, which has a debit in it, and therefore we're going to credit it to make it go down. We have the general service expense, which has a debit in it. We will credit it to make it go down. We have the nursing service expense, has a debit in it. We'll credit it to make it go down. And other professional service, unrealized loss, also having debit balances. We will then credit them to make them go down. Now, we're not going to do anything yet to these two accounts, the basically items that are going to be moving things from restricted to without restriction. We'll see that in a following journal entry. So this then where we stop. If we then were to take the debits, add them up. I won't pull out the trusty calculator because I know it's just adding, so you don't need to see me do that, although I enjoy it. And then we add up the credits. If we were to add them up and then subtract the two, what we would then need in order to make this balance out, which would be the credit of the $90,659. That's going to be the credit that we'll be recording. We will record that to the net asset without donor restrictions. So let's go ahead and post this out, see what it looks like, see if it does what we expect it to do. And, what we expect it to do, of course, will be to make all these accounts go to zero and then post the difference up top. Okay, so here we go. We're going to say got the patient service revenues, a debit. We have a credit in it, so we're going to do the opposite thing to it, a debit it, making it go to zero. We have the other operating revenues. It's got a credit. We debited it, therefore, to make it go to zero. We've got the investment income. We debited it to make it go to zero. We've got the contract adjustments. We credited it to make it go to zero. Admin expense. We credited it and made it go to zero. We've got the general expense, we credited it and made it go to zero. And then we had the nursing, the other unrealized gain. All credits is what we did to them. We credited them and we made them all go to zero. Just like what we had planned, everything is proceeding according to the plan. And then the other side, the plug, the difference, go into the net assets without donor restrictions. So the net assets without donor restrictions then has a credit balance. We credited it by the $90,659, which looks really familiar. Where have we seen that number before? $90,659. That's basically the net income type number that we have. And we closed out everything except these two. So why does that work still? Because these two, of course, will net each other out. They're the same, equal, and opposite. Therefore, what we've closed out at this point, basically all revenue and expenses. The difference between the two, revenue minus expenses, is net income. That being the amount that we're closing out to what would be similar to the equity section, similar to retained earnings or the capital account, here to net assets. So there is that, and we're increasing the net assets. The next transaction is going to be a reclassification of the net assets without donor restrictions. So we're going to be taking some out of the net assets without donor restrictions that are undesignated, and now we're going to be moving them into the net assets with donor restrictions, which are designated for plant. So to look at that, this is going to be, we're going to consider our transactions. Let's think about all the transactions we looked at. We had the cash investment, and this item here was for interest on investment in assets limited to use. So you'll recall that we entered this into something without restrictions, but now we're going to move it into another class of net assets without restrictions. And this item down here, unrealized loss on investment, also related to the same type of investments. So if we have the 8350 minus the 681, that's the 7669 that we're going to be reallocating. So therefore, that's going to be our journal entry here. We're going to be taking it out of the net assets without donor restrictions, which are undesignated. We're going to be moving them into, increasing with a credit, net assets without donor restrictions designated for plant. Therefore, if we post this out, then the debit is going to be on this side. We're going to be taking it out. The net assets without donor restrictions. So it has a credit balance. We're going to debit it to make it go down. Then we're going to put it into the net assets without donor restrictions, which is designated for plant. Has a credit balance. We'll be crediting it, making it go up in the credit direction. Next transaction, we're going to be closing out these two items. I'm going to do it one at a time. I think it's a lot easier to do one at a time. You'll notice that these transactions are called net assets released, satisfaction of purpose restriction without donor restriction, and then the net asset released, satisfaction of purpose restriction with the restriction. So we're just going to match up the withs and the withouts to the withs and the withs out up above in the net assets section. So first we're going to close out the one that will be without restrictions. That's got to be the credit here. So therefore, we're going to debit it to make it go down. And then we're going to be putting it into the proper net asset account. And that's going to be the net assets without donor restrictions, which are undesignated. So if we post that out, then it's going to look like this. We're going to say that the debit is going to be here, bringing this amount down to 0. Then we have the credit balance in the net assets. We're going to be crediting it to make it go up. So that's the other side of it, increasing the net assets. Then we're going to be recording or reducing this last piece down to 0. It has a debit balance in it. We therefore are going to credit it to make it go down. The debit side then is going to go to the net assets with donor restrictions. So we'll post this out. We are then going to say that the net assets with donor restrictions has a credit balance in it. We will debit it to make it go down. Then we have the net assets released, has a debit balance in it. We will credit it to make them go down.